Good morning, and thank you for joining our not-for-profit webinar, Getting Ready for 30 June 2025. I'm Elizabeth Blunt, and I'm the National Not-for-Profit Leader at BDO, and I welcome you to this webinar. Just first up, I'd like to do acknowledgement of country. So we begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. We extend that respect to Aboriginal and Torres Strait Islander peoples here today. Just to start off with some housekeeping. So if you have any questions, please submit your questions on the questions tab. I can't promise that we will get to answering all of your questions, but if we have time, we will answer as many questions as we can during the session. But post-session, we will provide you the presentation slides and answers to any questions that are asked as well. I will also provide you a link to the recorded sessions and access to other webinars in the series and all of our contact details. If you are experiencing any technical difficulties, please visit the link on the page here. And I'd like to introduce my fellow speakers on this webinar. So firstly, I'd like to introduce Frederick Hauser. So Frederick also goes by Freddie, and he is a director in our IFRIC and Corporate Reporting Assurance team. This is the first webinar that Freddie has done at BDO because he's recently joined us from the AASB. Very excited to have Freddie on board because Freddie used to work at the AASB, specialising in the not-for-profit sector. So it's fantastic to have him as part of the team, and he'll be providing an update on financial and sustainability standards. Next up, we have Ben Renshaw, and Ben Renshaw is our national leader in the payroll advisory team, and he will be giving us an update on pay compliance and fair work. And then lastly, we've got Leon Fouche, who is from our Brisbane office and is the national leader of cybersecurity. So on our next slide, we do just have a brief overview of today's agenda. So firstly, Freddie will give us a financial and sustainability reporting update. So firstly, he'll start with a regulatory update. He'll talk a little bit about accounting in times of uncertainty and other topical issues that are impacting the sector at the moment. Standards applicable to the first time at 30 June 2025, and also what we can expect to see on the horizon. Then Ben will discuss payroll compliance and fair work. Ben has recently been working on a couple of large fair work audits in the not-for-profit sector, and also discussing effective payroll reviews. And then Leon will be presenting on cybersecurity trends and challenges in the not-for-profit sector. And the reason we chose Leon is because the ACNC had noted that cybersecurity is one of their key compliance focus areas. And so Leon will be talking about examples that are out in the public domain, so no confidential matters, but looking at key trends and emerging risks, your cybersecurity obligations, and some practical tips and resources for not-for-profits. So I think we get straight into it. And Freddie, I will hand over to you to start on the financial and sustainability update.
Thank you very much, Elizabeth, and great to be here. Hello all. So moving on to the regulatory update, once I will get the hang of the slides. I put here on slide what are the focus area of ESIC coming into this reporting period. I appreciate that ESIC is not necessarily regulated that applies to many or majority of the not-for-profit entities, but it's always useful to see what they are looking at because these areas are aligned with the areas we are focusing our attention as well. So no surprises, revenue recognition, despite the fact that the standard has been in place for a while, is still a topic that comes through our desks. Given the current uncertainty, also impairment and asset values, including disclosures, is something that we'll be highlighting to to our clients, and not necessarily just impairment, but also disclosures of their natures, etc. Another area to be aware of is provisions to make sure that they have been recognized appropriately and also valued as they should be according to the accounting standards. Given times we are living, it also pays to pay attention to events that are occurring after the end of reporting period, just in case they need to be either disclosed or they may actually have impact on reported numbers in the financial statements. One of the other areas I would highlight are disclosures, not necessarily operating and financial review, which is not necessarily directly applicable to not-for-profit entities, but those disclosures in a financial report. And we'll be talking about them a little bit later. Uh, it's either disclosures of those significant uncertainties or estimates or assumptions, but also disclosures of accounting policies. And of course, sustainability reporting is the quite topical with the onset of mandatory reporting for those entities that are captured by mandatory reporting in terms of sustainability and climate related financial disclosures. It may not necessarily apply to many not-for-profits, but we will talk about it because some not-for-profits will be captured at some point by this reporting, and ESIC issued quite useful regulatory guide recently. Moving on to the findings from the recent ESIC financial reporting surveillance, couple of things I will highlight there. In terms of the impairment and asset values, again, impairment may be not necessarily topical issue for not-for-profits, and when we are looking at impairment indicators, we need to be conscious of the approach and the allowances made in WSB 136 for not-for-profits, and for example that for the assets that are not carried for cash generation but for service potential, their value in use may be usually lower than the fair value, and then it really goes down to how do we measure fair value in not-for-profit space for assets held for service potential, but also recognition and disclosure of those financial assets and financial liabilities as current or non-current, and sometimes, for example, definition of cash. Revenue recognition, the definition or specification and identification of performance obligations, and their being sufficiently specific, is again an area that attracts significant judgment, and we are looking at this for our clients quite a bit, as well as agent versus principal considerations is something that is probably more complex in not-for-profit space compared to for-profit organizations. In terms of the disclosures, disclosures like going concern, comparative periods, it's something that again attracts regulators and our attentions from audit perspective. One thing I would highlight is that ESIC, but also other regulators, would be looking how clients have assessed and analyzed their positions and application of accounting standards, and how they documented that analysis and consideration, and whether those entities have engaged, have either skills internally or have engaged with their advisors and experts to obtain those necessary skills. So my colleagues in our BDO, IFRS, and corporate reporting team have been running series of articles how to come up with a good accounting position papers. So I have put some links on this slide, so please feel free to have a look. And of course, always come and talk to us if you have any questions. As Elizabeth mentioned, you have our contact details. Moving from the ASIC to ACNC, which is probably more relevant regulator, I have copied out here on the slide few of their findings from the latest financial statements and annual information statements reviews that are available. They are quite dated, but they are still, I think, applicable at least in some cases. One of the findings at that time was the disclosure of the keeper's management personnel remuneration. It's probably because at that time it may have been quite recently added disclosures. But other findings were quite interesting and maybe just require some basic hygiene in terms of the review of the financial statements. First, to make sure that we are providing complete financial statements, and secondly, there are no discrepancies and inconsistencies between financial statements and, for example, annual information statements submitted to regulators such as ACNC. And in terms of the disclosures, one I would highlight is again the disclosures of those accounting estimates and judgments, because they may have changed over the time. And again, given the current economic and regulatory and broader environment, it's always useful to keep that in mind, that we need to refresh the views. And with that regard, obviously, in terms of the risks and opportunities faced by the entities, those are changing over the time. I also provided update on the ACNC's registrations, and ACNC has made publicly available the information that they have experienced significant increase in the registrations, partially also due to the ATO self-assessment income tax reforms. On that, I have provided an update on that process on this slide. As you probably will be all aware, there was an extension to provide that self-return for 2023-24 income year by 31st of March this calendar year. Those not-for-profit entities that haven't launched yet may need to do as soon as possible, but they do not need to request extension from ATO. And as a part of the transitional support, ATO suspended the penalties. We also have an article on our website in terms of helping not-for-profits with assessing this return and submitting this return. And one of the characteristics or areas we are zooming there is also the fact that those winding up clauses, or the prohibition of distribution in terms of the winding up clauses, should be also in relation to day-to-day operations of not-for-profits. That's something that we probably want to have a look in case you need to update your deed or constitution. I already mentioned a couple of times the uncertain times we are living. To help our clients with that and how to apply accounting standards and prepare the financial reports in terms like this, we have prepared or released recently a publication which probably refreshes some guidance we already put out during times of COVID. Whilst this publication probably focuses more on tariffs, which are not necessarily probably as applicable to not-for-profits as to for-profit entities, you can easily see how those uncertainties then translate into the broader economic uncertainty, and not just tariffs, but US aid, etc., which may have some first or second order implications for not-for-profits. So clearly, that uncertainty and broader economic uh, possibly downturn may impact on asset values and may have some impairment implications. I already mentioned that value in use is not necessarily as applicable for those assets that are carried not for cash generation but for service potential. But then obviously the application of fair value in not-for-profit context becomes important. Always think about what assumptions, scenarios, inputs we are using, and are they up to date, and are they supported by evidence, and have we documented that thinking process, but also have we ended up disclosing those key assumptions and inputs in the financial statements, because it may constitute material information. Apart from the asset values and impairment and fair value considerations, there are other considerations to be aware of. What about our contracts with customers? Do some results in onerous ones? What's the impact on non-covenants? And again, we'll talk about classification of financial liabilities, current versus non-current, shortly. Do we have any deferred tax assets, and some not-for-profits will be at least partially taxable? And what does it mean, for example, on our credit impairment losses on receivables, if we have any? I already mentioned provisions, and how does it impact, for example, discount rate or our future obligations. So again, I think the main message here is to, at times like this, please do pause and have a look whether anything what you have done last year or most recently, is it still valid and applicable, or does it need a refresher? As I'm sure you will always do when you are preparing financial statements. Sometimes it's necessary to look at those aspects prior to the end of reporting period, just in case there are some important actions to be made. And for example, we'll mention one of them when we are talking about loan covenants. Moving on to other reminders and topical issues, what we are seeing. One is, I already mentioned, income and revenue recognition. Identification of performance obligations to see whether that particular agreement or contract is within the scope of WSB 15 is a perennial and very judgmental topic, especially in a not-for-profit space, given how agreements are being written. And personally, I see it actually much more complex area at times compared to the for-profits, because not-for-profits have at least one additional standard to deal with, which is WSB 1058. And once you're in WSB 1058, you actually end up find yourself back into WSB 15 again. So determination of the scope, which standard I'm dealing with, and then if I'm in WSB 15, do I have a sufficiently specific performance obligations using that guidance, can take some time. So please do pay attention. Obviously, with each new agreement, a new contract, that assessment needs to be done at that contract level to, for example, determine whether that quantity, time, specifics of that promise to transfer benefits to beneficiary is sufficiently specific. And if not, we need to bundle it with other promises until we'll get to that level where we are achieving the sufficiently specific. And if there are no sufficiently specific performance obligations, then we are back to WSB 1058 and to see whether we have other related amounts to be recognized in respect of, for example, assets received at amount less than its fair value. That consideration is then quite important when we are assessing whether we are agent or principal in the agreement, and many not-for-profits are performing activities on behalf of someone else, and so it's important to determine what are the activities. Are they promises to transfer benefits to beneficiary? And if so, is the not-for-profit entity in the role of agent or principal in that arrangement? Or, for example, have we received, for example, cash or another financial asset, but at the same time we have a financial liability to transfer that financial asset to someone else? Recently, WSB have completed the post-implementation review of revenue and income accounting for not-for-profits, and decided not to make or propose any changes at this point, but they will consider future project proposals, how to, for example, amend or clarify guidance in Appendix V, the WSB 15, and for example, whether the income recognition from IPSASB could provide a better framework to recognize revenue for Australian not-for-profits. But they will only do that after they have finalized, especially Tier 3 project and WSB 18 considerations for not-for-profit entities. So at this point, we have status quo. So we have those standards to deal with, plus guidance that WSB and BDO and other firms have released how to apply those standards. Another quite topical issue is portable long service leave, especially with the introduction of the concept recently in New South Wales, but obviously it's present in other other states for community services sector. Number of the callouts here, it is important to assess whether entity still has a obligation to provide and pay those long service leave to their employees, and if so, it needs to recognize a provision for that long service leave in accordance with WSB 119 employee benefits using the normal process they would usually do. We need to be conscious of that portable long service leave from portable long service authorities do not necessarily cover all entitlements that employees may have under long service leave arrangement. For example, sometimes the arrangements will be more generous, or for example, long service leave authority will not necessarily cover superannuation element. What has changed that depending on the scheme, they may have the community service organizations and not-for-profit entities may have legal right to recover uh, part at least of that long service leave obligation, and therefore there is a potential to recognize an reimbursement asset or an asset if it's virtually certain. So entities will need to go through and put down debits credits against individual flows and events transactions, whether it's payment of the levy to the portable long service leave authority, recognition of long service leave, recognition of the asset in terms of the reimbursement from that long service leave authority, potential netting on P&L side. It's unlikely that we would achieve netting on a balance sheet perspective. We have an article that we have released quite a while ago, but I think it's still applicable, and we are working with our clients to the extent we can on audit side, maintaining our audit independence to ensure that they get it right. But also we are advising on those clients that we can in terms of how to implement those changes in compliance with Australian accounting standards. In terms of the hygiene, I put this slide because I do still feel that as a sector, and not just not-for-profit, we can still do more to ensure that we are disclosing material and relevant accounting policies. Many times I will come across in my team across accounting policies that are irrelevant, they are not material, they are quite generic because they may have been taken straight out of the template financial statements, and that's not necessarily helpful. So if we are preparing financial reports that are meant to be useful to the users, whether it's regulators or our members, etc., we need to make sure that those accounting policies are quite specific and are talking about the arrangement that that particular entity has, and it's not necessarily a rocket science. It just requires a bit of cleanup, because otherwise, if there is too much generic information, it actually may impede the understanding of the financial statements and the basis on which they are prepared. In relation to that, one call I wanted to make sure is that we are distinguishing between the significant estimates and judgments and accounting policies, mostly also because there are different parts of the standards, whether it's WSB 101 for those that are preparing Tier 1 financial statements, or respective paragraphs of WSB 1060 for those that are preparing Tier 2 financial statements. So this decision tree really just reinforces the message that have a look whether that accounting policy and or judgment and estimation uncertainty is material and relevant qualitatively or quantitatively, and if so, disclose those information that is required in accounting standards. If no disclosure is required because it's not necessarily material or relevant, then don't necessarily disclose and clutter financial statements, but it's not necessarily set and forget. As I already mentioned, those assumptions and nature of uncertainty and or business and operations and therefore accounting policies may change over time, and something what we have done or not have done last year or last time, and it was appropriate, may not be appropriate anymore. So again, when you are reviewing financial statements for 30th of June 2025, do pay attention to these types of detail, because again, the world looks perhaps different to what it looked this time last year. Moving on to the standards that are first applicable for the reporting periods ending 30th of June 2025. There's a couple of standards that are not necessarily too they don't necessarily have too heavy applications for not-for-profits, I guess, but some of them might. So one of the most important ones, which I will cover in a little bit more detail, is the classification of liabilities as current and non-current. And because international and local standard setters, they actually have a couple of goes at it. We have a fair bit of thought leadership and collateral on our website. So please do, after this webinar, have a look if you already. There are also some amendments in terms of the lease liability in the recognition of the sales and leaseback and supplier finance arrangement, which are, I guess, not necessarily as applicable to not-for-profits. But also WSB released in 2022 amendments to WSB 13, how to implement and how to measure those assets not necessarily held for cash generation but for service potential, and how to measure their fair value. We will cover that in a bit more detail shortly. This was meant to really help those entities how to apply something that was really designed for profits in mind for in those not-for-profit circumstances. So in terms of the classification, current versus non-current asset 30th of June 2025, we have actually released our publication, Accounting Standards in Practice, as we tend to, and it does have a very useful decision tree incorporated in it, which is essentially translating requirements of accounting standards in hopefully helpful way. And it does step through whether we have loan arrangement, when which means that those paragraphs of WSB 101 become applicable, and whether the loan is scheduled within the 12 months or not. And then it steps through whether we have right uh, to roll over the settlement over the next 12 months or not, and if there are covenants that we need to comply with. What happened is that ISB and AASB in 2020 have released amendments which were essentially asking entities to look at the compliance of their with the covenants that are not necessarily applicable for the year end, but they may be failed, if I use that term, after the year end. And those amendments would have effect that it would change the classification current non-current as at that reporting period. After relatively strong feedback, I wouldn't call it uproar, following those amendments, standard setters had another go at it, and again, I would say probably won back those proposals or those requirements. So at the moment, those covenants, they will have effect on current versus non-current classification only where there is non-compliance prior to or as at the year end. Entities are not necessarily looking whether they are expected to comply or not comply after the year end. However, there are new disclosures that come with the amendments. Of course, as was practiced in the past, period of grace and waivers may also have impact on the classification as whether the liability is current and non-current. On this slide, I have highlighted few considerations. One to be aware of is a really difference between period of grace and waiver, and whether the period of grace would cover the next 12 months after the reporting period. And also, if entity would be non-compliant with the covenant and would like to obtain a waiver, please do make sure that you are obtaining the waiver prior to the year end to ensure that it is actually effect or helps with the classification of the liability as at the year end. The other one would be also the consideration of potential finance or access to finance is not necessarily sufficient for the current non-current classification. It's really looking at whether the right exists as at the reporting aid, regardless of what are the potential events expected to happen after the year end. And I already mentioned the disclosures. If we have covenants, there are some additional disclosures to provide information around those, even if we are complying with them as at year end. I already mentioned that we have a lovely publication, so please do go on a website and have a look at it. It's very useful, as are all publications what we have. In terms of the fair value measurement, uh, I'm not going into too much detail, and I have to highlight it is specific for not-for-profit public sector, but I put it in a slide because it reinforces considerations not-for-profits should take into account when they are looking at the fair value of their assets. And again, not necessarily many not-for-profits will choose to measure their assets at fair value, but that consideration may become important when they are looking at impairment of their assets held for service potential. And it's really whether the current use is also the highest and best use. What would be the considerations that market as participants would take into account looking at that particular asset? And in many cases, not-for-profit entities will default to the cost approach, which really means current replacement cost, which would then reflect economic obsolescence. And again, the fair value of the asset is not necessarily just the way how the not-for-profit entity is using the asset, because other market participants would look at that asset and look what would be the cash generated by that asset, unless there are restrictions that are not removable from that particular asset. So if you are having some considerations or question marks around fair value of the not-for-profit assets, or those assets that do not generate cash flows but held for service potential, uh, the standard and publication may be helpful, but I need to stress the point that WSB decided to limit those amendments only to not-for-profit public sector entities. In terms of the recent IFRIC or IFRS interpretation agenda decisions, there is a fair bit of them, and I put them on the slide, and we have associated publications to go with that. Two that I will highlight are those agenda decisions on tuition fees and on the climate-related commitments in terms of provisions, which may help when entities in not-for-profit space, for example, would be looking at the recognition of the provisions. Tuition fees could have been helpful for not-for-profit and, for example, schools. However, ISB decided not to dig deep in terms of the interpretation of the standards because they didn't think there is diversity in practice looking at it as a global standard setters. Conscious of time, in terms of the what's on the horizon, it would be remiss of me to not to talk about proposed tier 3, and I know that we've been talking about this project at this forum for a while now. This is just a reminder what that project may mean, and essentially it would introduce new simplified accounting, including measurement new tier being tier 3, but it would possibly remove ability to prepare special purpose financial statements for those entities that are required to prepare financial statements in accordance with Australian accounting standards. So this slide illustrates a CNC charity situation. Obviously, there may be need to change either legislation or regulation to consume the new accounting standards if and when it's finalized. What that proposed tier 3 would do, I'm not going to in a detail, maybe we'll have a separate webinar on that in future. WSB is now still working through those proposals, but significant simplification in terms of the accounting policy choice, whether to present consolidated financial statements or not, simplified revenue recognition, and for example, recognizing all leases as operating leases. So there are significant simplifications for those entities that will be able to apply tier 3. But for example, some entities that will be too large in the eyes of their regulator to apply tier 3 may need to, I would say, step up from special purpose financial statements to tier 2. And how big that step up will be, or if whether it step up at all, will really depend on the quality and the scope of those special purpose financial statements they are currently preparing. As a matter of update, most recently, WSB discussed the feedback at their May meeting and decided to proceed with deliberations on those proposals, following the feedback they received on their exposure drafts recently. And the staff papers noticed that the standard is expected to be finalized at this stage in the first half of 2026 calendar year, so next year. Plus, I think WSB signaled that there would be 3 year of period between the standard is finalized and its mandatory application date. Moving on to IFRS 18, something again to keep in mind and on horizon, that this is the standard which may change the way how profit and loss looks like for many of the entities, because it's introducing some additional requirements in terms of categorization between operating, financing, and investing categories on the profit and loss side, not necessarily cash flow, but trying to analogize there. But also how we aggregate and disaggregate either balances and events on the face of the financial statement, but also in the notes. One highlight here is that applicability of IFRS 18 in Australia was deferred for not-for-profits to 1st January 2028. For-profits are starting 1st January 2027, and WSB will consult whether any not-for-profit amendments are needed in IFRS 18 before it will be mandatory applicable for not-for-profits. While we are on consultations, WSB will be also coming out with asking for feedback on 16, which I suspect many entities will have. We all know that not-for-profits are navigating, for example, how to determine incremental borrowing rate for their leases. And also, and that's something what to be aware of, WSB 1060 at some point potentially may change to in light to with changes introduced by WSB 18 or 19, and changes that were recently made to IFRS for SMEs. Last but not least, service performance reporting. That is not for profit specific project, recognizing that obviously this type of reporting is mandatory in New Zealand, at least for some not for profit entities. There hasn't been update at WSB recently, but I do know that WSB staff planned a targeted consultation on that working draft, which was based on New Zealand standard FRS 48. So stay tuned. So that's actually a nice segment into the sustainability update. Again, traditional financial reporting is not necessarily cutting it for not-for-profits, and therefore, for example, performance reporting is an important project, but also sustainability reporting is something that is important in important work in financial reporting and broader reporting landscape. Whilst not that many not-for-profits will have that obligation to report sustainability and climate-related financial disclosures, there may be some, being companies limited by guarantee, that are not registered as a charity with ACNC, and if they are lodging a financial report with ASIC under Chapter M, they may be subject to mandatory sustainability reports subject to the size criteria, which are summarized on this slide. I will not go through detail, but again, if you haven't gone through this decision tree yet, and you feel like you possibly might be captured by sustainability reporting, then please do that ASAP, because it's very new and not necessarily easy area to navigate in terms of determining your reporting obligations, but also what goes into the report, and the time is ticking. The sustainability report is in compliance with WSB S2, which is the climate-related financial disclosures here in Australia, is not necessarily just about reporting the greenhouse gas emissions. It's much broader than that, and it really steps through governance, strategy, risk management before it gets to metrics and targets. So there is a ton of work that would have to go into the preparation of an entity for sustainability reporting. So just an important reminder, if you are being asked, or if you think you want to do this, or you think you will have to do this, please do and come to talk to us ASAP, because there is a significant amount of work that needs to be done. I will probably skip through the slides, just timeline and assurance requirements, which are limited to start with, but then they will kick in into the reasonable assurance very soon for some entities. And just a last reminder that we are running monthly webinar series across financial reporting and sustainability reporting that are not necessarily not-for-profit specific, but are very useful. So if you would like to, please do come to our website and register. Thank you very much, and back to you, Elizabeth.
Thank you very much, Freddie. And I guess you covered a lot in that section. A couple of key points, and I just wanted to say from a 30 June 2025 audit, you mentioned the ASIC focus areas of disclosure being the revenue recognition, and it is so much more complex for not-for-profit organisations because there are the two accounting standards, plus there's multiple contracts. Most grants will all have a different contract, so they do all need to be assessed. And it's also really important to get the disclosure accurate in the financial statements because there is judgment involved in applying the accounting standards. The other thing I wanted to mention was on the portable long service leave. So as Freddie mentioned, Victoria and Queensland introduced it in the community services sector a few years ago. If you have employees in the community service sector in New South Wales and South Australia, it is applicable to start paying the levy from 1 July. I think one of the most complex areas was determining, when it was introduced in Vic and Queensland, was determining which employees are eligible and fall under the Act. So you will be required to get legal advice on that, but then also then the accounting for it is complex. So talk to your audit partner about that to ensure that the accounting is correct in your financial statements. And then I guess just also on the fair value measurement, as you mentioned, we are in uncertain times. There's been a lot of change. So if you have assets held at fair value, it is important to ensure that those fair value measurements are accurate. And again, the disclosure in the financial statement, because there are key estimates in that. So we'll move right along and moving on to Ben, who's going to talk about pay compliance.
Thank you, Elizabeth. Thank you, guys. And it's nice to be here talking to you today. My name is Ben Renshaw. I'm the BDO lead partner for employment taxes and payroll consulting. I'm going to spend a very few minutes talking about payroll compliance and some of the hot topics or hot things to be looking out for. We could spend a separate hour or more on this, but we'll try and cover it very, very quickly. So I often get asked, well, how do we know if our payroll is working properly? And sort of the approach that we've come up with that we use is to look at sort of 4 pillars of a payroll review, and they sort of break down into these 4 areas. To me, this is about being able to hand on heart say, yeah, payroll is working. I think you have to be confident across all of these areas to be able to say that. So I won't spend too much time on each, but on the left there, that pay against award piece, I think we all know this is a pretty complicated area in the not-for-profit sector. Whether you're driven by the SHADS award or some of the other awards, or you have an EBA, it tends to be complicated. You tend to have lots of not-for-profits have a broad span of employees doing lots of different things. I always, in my mind, I always think about disability service providers in particular, who could have people doing sleepovers and broken shifts and all sorts of complicated things, as well as providing a host of other services, which just makes it difficult to understand. The other thing, I think it's fair to say that these industries are often not particularly high paying, and as a result rely on the awards and EBAs and the rates within them to pay their people. And as a consequence of that, however, a small mistake can become a problem quite quickly because there isn't too much buffer. So we often recommend that that organisations do a review of that pay against award piece. And it doesn't have to be a full employee review necessarily. You might pick a topic or an area or a bit of the business and take a few sample employees out and do an independent review for 2 or 3 pay periods to go, well, you know what, this is when this person worked, this is what they were doing, this is their classification, this is how much they should have been paid under the instrument. Does that match up with what they were actually paid? And if not, why not? So you might do that review in a fairly targeted manner to begin with, and if it identifies any concerns, look at possibly a deeper dive review, or in the worst case, a full recalculation and remediation activity where mistakes or errors are identified that require back pay. So that's the first piece of are we paying people the right amounts? The second piece, the wage code review, is really, are we treating the amounts that we should be paying people correctly? And this is it's more of a tax focus. Do we have the right withholding happening? Are we paying the right superannuation? Is our FBT treatment correct? Keeping in mind that salary packaging is prevalent and potentially very helpful for lots of people in the not-for-profit sector. Are we capturing the right REM or comp for workers' comp insurance or work cover? And then for some organizations, at least, payroll tax is a similar consideration. So making sure our payroll is configured properly from a wage code perspective. Are all of those wage codes configured in such a way that are going to lead to the right statutory or technical outcomes from a compliance perspective is really important. And then here, the two on the right are becoming increasingly, the next one at least, increasingly challenging. I think we've touched on it already today, so I won't spend too much time on it. But we find lots of activity from regulators around leave accruals, whether leave accruals are correct and whether they're being paid out properly, particularly long service leave. As we probably all realise, there's you could have employees that have been with you for a good long time and accrued a huge amount of long service leave. And for organisations that have perhaps changed payroll systems or processes during that time, we often find that the rate of accrual or the amount that's transferred from one to the other is incorrect. With other complications thrown in. People who work a variety of different work patterns, maybe they're 3 days a week for 10 years and they go to 4 days a week and then 2 days a week, or whatever it might be, can impact the accrual rate. Making sure non-accrual periods have been dealt with properly, making sure that leave that's been taken has been paid out correctly. And then challenges around people moving states as well, because as we know, all the state rules are different from a leave accrual perspective, and portable long service leave just adds onto that. I would say that it's a high focus area at the moment. The Victorian Wage Inspectorate, for example, are very focused on long service leave payouts, so we're seeing a lot of activity in that space, and it's difficult to get right and keep right. So it's a good thing to maybe spot check from time to time. And the last of the 4 pillars really is the kind of a more traditional end-to-end process review. Do we have the right process, risk, and risk management and controls in place, with our sort of cradle-to-grave payroll process? More of a typical people, process, system sort of review, but understanding, well, is it right? Is it appropriately controlled? Do we have the right sign-offs? Do we have the right segregation of duties? Do we have the right redundancies? Are we using the correct software? All of those sorts of things that really bring all this together. Which for some people sit within an internal audit function, depending on your size, but it sort of ties the whole thing together, really. If everything else works, but your process doesn't use it properly, you're still likely to have problems. So they're the 4 pillars we suggest people look at, perhaps not all at once, but it's something to sort of work through and go, well, in the next 6 months, we'll look at this. Maybe the following 6 months, we'll focus on something else, just to make sure payroll is healthy and functional as possible. We might move slides. I might skip the next one and go to the next one, please. So I wanted to spend just a couple minutes on Fair Work investigations because we are seeing a lot of them. Fair Work aren't shy about publishing these either, particularly enforceable undertakings. And there's a few things at play here. I think because we said earlier that not-for-profit organisations sometimes sail quite close to the line in terms of how much they pay people. It's a necessity. There isn't lots of money always floating around for staff costs. it can lead to mistakes really quickly. And Fair Work are conscious of that, particularly when you add in the complexity of the shads and the other awards that you guys are working under. So we are seeing lots of Fair Work activity. It doesn't take much for them to get interested, particularly employee complaints, employees or unions for that matter, or former employees going, oh, I don't think I was paid properly. Fair Work will investigate those things. My sense is they don't want to focus on this not-for-profit sector especially, but they really have no choice. So it is happening, and it could always be a possibility. I think if you've taken those steps that we talked about in the previous slide, you can be well prepared for this. But it absolutely could happen, and it's something that needs to be taken seriously if it does. Worst case, with a Fair Work investigation that requires back pay remediation, you might be reconstituting payroll for current and former employees for 6 or more years. So it can be a difficult, challenging job and needs to be taken very seriously if that's where you end up. Now, I would say Fair Work have recently published a remediation guide, which is quite a good document. It sort of sets out their expectations around how a remediation process, if you do have to do back pay, will be undertaken. Things like what they expect the scope and the methodology to look like, how they expect you to deal with comms and payroll and payment processes. Key things really is they want to see that the employee is being put at the center of that remediation program if you have to undertake one, and that particular industry, business, sector specifics are taken into account. And that particularly goes for where record keeping is a problem. If you have to reconstitute work pattern records, for example, that you do so taking into account realistic scenarios that might have occurred in the business, rather than just saying, well, we don't have the records, we'll assume everyone worked from 9 to 5 and that's it. They don't like that sort of approach. So including former employees are really important, and then they also want to be sure that when mistakes and errors are identified and remediated, they're fixed for the future. I'm super conscious of time. There's a huge amount of information there, but I will pause with that. But we are available, obviously, to take any questions on this topic as they come up.
Thank you very much, Ben. And I guess just to add to that, in July, we are going to have another payroll compliance webinar, which will talk about the complexity of the payroll compliance under the SHADS Award, as well as the technical aspects that underscore the complexity and ensuring that the right payroll systems are in place to manage the requirements effectively. So you should get notified of that webinar, but that webinar will be coming up in July. Thank you very much, Ben. So moving on to Leon, who will be discussing cybersecurity and trends and challenges that are currently impacting the not-for-profit sector.
Thanks, Elizabeth. We're running short of time. We are going to have a more focused digital innovation cybersecurity session that we planned in the coming months. So what I'll do is in the next sort of 5 to 6 minutes, quickly go through this. So we just go to the next slide. We've seen a lot of innovation happening and technology adoption within the NFP sector, where NFPs are really embracing sort of the new innovation and technology changes that's happening. And that's really extending their fundraising platforms, their communication, their interactions with donors and stakeholders. But through that adoption of new technologies, there's sort of new emerging cyber risks coming through. So we're still seeing a lot of phishing emails, business email compromise, which effectively is where hackers are using sort of emails to solicit staff to actually do falsified payments and commit fraud. I think the adoption also of more online presence in NFPs, we are seeing more fraudulent donation websites actually springing up. And then also ransomware, given the footprint of the NFP is actually increasing now, so does actually the platform and environment for hackers to sort of use that as a method to attack organizations. Next slide. I think also if you look at, given that a lot more data sort of coming in, we're seeing NFPs really sort of embracing taking a data-driven decision making. So we're seeing CRMs a lot more integrated into their systems. But with that comes a risk that the more data you keep, the more sort of a focus area or honeypot that you're getting for hackers, because you tend to have a lot of sensitive information, a lot of personal information, a lot of healthcare information. So keep in mind that you can only protect really the data that you sort of house yourself, but we're seeing more and more service providers actually providing services to NFPs. So keep in mind that is not just looking at your own cybersecurity, but also those of your service providers. Go on to the next slide. Probably skip over this one. Another area is we're starting to see also the adoption of generative AI, and that really sort of we started using that as an ability to speed up some tasks, re-automate some administrative tasks that we probably don't have a lot of time to do. We also seen some NFPs taking some interesting approach where they're using that data to help them inform making decisions all around. Now, given the adoption of AI, our hackers are actually really starting to use the same technology. So we're starting to see more shadow AI tools sort of coming to market where hackers are using that to really use the tools that you've got to create and provide service to your stakeholders. They sort of engage with those to sort of really breach and hack into your environment. I think also if your staff is not using approved AI technology, there's a risk that you provide sort of information into those AI environments, which potentially can expose you to privacy breaches down the track. Let's go to the next one. Next one. I think just something to keep in mind, as I talked about, we're starting to see some hackers already embracing AI technology. There's technology like WormGPT, FraudGPT, which really fraudsters are using to create realistic emails, and they solicit that information to sort of really attack you and sort of convince your staff to sort of click on links, make it look like it's real. We're also seeing deepfake AI tools like 11 Labs, which is creating voice cloning, which is sort of really creating a plausible Teams or a video conference interaction where effectively it looks like it's a real person. So really keep in mind that those sort of technologies are emerging. And then also, given that a lot of NFPs are now adopting a digital footprint, AI tools have the ability to sort of really go wide and look at creating realistic photos, documents, company names, and really sort of make it real. That's quite difficult to sort of detect that's out there. Next slide. So just quickly, a couple of regulatory obligations that NFPs need to comply with. I think the ACNC is not the only one, but really that's an important sort of resource that's available there. And that's really where boards and leadership teams need to make sure that they are really clear on what's expected from them to manage cyber risk, like they do today with financial and legal risk. They've got a responsibility to ensure that personal and sensitive information, including donor and client records, are really kept safe. Provide some guidance on incident response plans and what to do quickly when a breach sort of occur. And it's also importantly to make sure that it's not just the NFP's own cybersecurity posture, but also looking at your service providers and how good they are from a cybersecurity perspective. I think the newest legislation, which is the Cybersecurity Act, which came into law the end of last year, that's bring several mandatory requirements for NFPs. So if your annual revenue is over $3 million, you're obliged to actually report any ransomware payments that you made within 72 hours. And that's quite a substantial obligation. I think the other one is also that you have to report any significant cyber incidents, depending on how critical that is. And also that act actually paved the way for any future mandatory breach disclosure requirements. So it's really important that you get an understanding of the Cybersecurity Act. The Privacy and Notifiable Data Breach Scheme, that's really important to also keep in mind because that's really required. We have to notify the Office of the Australian Information Commissioner on any individuals that got impacted by a data breach. It's got quite specific security requirements that you need to adhere to to protect data, including also how you store and retain data, both locally and offshore. Next one. I just want to leave you with a couple of practical tips. And as I said, we'll have a separate webinar. We'll go into a bit more detail into this. I think the first one is really around managing your digital identities, because you created those identities and sort of username passwords to give you access to your environment. So really, that's the important part you need to protect. So using multi-factor authentication is really essential, because that will really stop any malicious hackers trying to take accounts over. Next, it's really important to train your staff and volunteers and your service providers in recognizing suspicious emails or phishing attacks, because that's most likely the first interaction will be that you will have with a potential hacker. It's also important that you do back up your critical data and test that in a regular way, because that really enhances and builds resilience that should you suffer a data breach or a cyber incident, that you are able to effectively recover from that. Next, it's really important to make sure that all your systems and applications and devices, the security patches of those are kept up to date, because hackers quite often explore unpatched or outdated software when they sort of attack organizations. Next one is really about making sure you're using strong, unique passwords, and even adopting a password manager to help you maintain using strong passwords. Hackers often share credentials that's been breached, and it takes an 8-character password takes a few minutes to a couple of hours to sort of guess if you don't have a strong password. And then finally, making sure that you really understand who's got access to your data, where's it stored, how safe it is, because removing unused accounts or even limiting administrative accounts really helps you reduce your risk. And then the last slide, just a couple of things sort of to keep in mind. There's a lot of resources available for NFPs that you can get access to. I think the ANCNC Governance Toolkit for Cybersecurity is a great resource where it sort of helps boards understand what's required from them, both from a leadership perspective, but also how to manage risks. The Australian Cybersecurity Centre has got a cybersecurity guideline, and it's probably one of the best plain language guides available that's out there, and really help organizations to put basics in place like multi-factor authentication, backup software updates. Another initiative that the federal government's undertaken is it's a Cyber Wardens program. So that's basically providing free national training dedicated for small businesses and NFPs. So really it helps you to build internal champions to help you with cybersecurity training. The Office of the Australian Information Commissioner, which is really related to the privacy and notifiable data breach, has got a guideline in place, and it really provides a step-by-step guidance for you to how to identify, report, and respond to serious incidents. And the last one there is we all use Microsoft. Microsoft's got some not-for-profit software out there. A number of those got really free or low cost for not-for-profits. So I really encourage you to have a look at that, talk to your service provider, and see if you qualify or have access to that. That's me.
Thanks, Leon. Really appreciate all that information. And I think the introduction of AI is really exciting, but it kind of it continues to increase then the cyber risks to organizations. So we've reached 12 o'clock just after, so I hope you could stay on to the end. A huge thank you to Freddie, Ben, and Leon for all of your insights. As I mentioned, or as both Ben and Leon have mentioned as well, is we will be having some longer webinars in the coming months on both the payroll compliance and cybersecurity. Our details are in these slides, and you will receive these slides after the webinar. You can also subscribe for more BDO insights that we have mentioned during today's webinar. So thank you very much for joining us today. I hope you found this insightful. Please leave your feedback, and if you haven't asked any questions, we will endeavour to get back to you on your questions. Thank you very much, and we'll see you next time. Bye.